welcome back to the Jameson Brandon channel, where we talk about all things money. Today we are going to continue our conversation with the macro and check in on some data. I got some Magnified Money studies and some BOA and Goldman data that when you put it together, it starts to tell you a bigger story of where we are at in the macro. And I think that this is really, really important, right? We have to keep reassessing. We have to keep looking at variables and redefining, do these variables matter? Do they not? And trying to figure out the most important question, which is where are we at in the cycle? That is one of the only definable questions we can ask. Where are we going? Who knows? When? Who knows? But we can definitely figure out where we are at. Okay, so let's start at the top. What we've got here is we can see that 40% of investors said that they have taken on debt to invest, including 80% of Gen Zers, 60% of millennials, 28% of Gen Xers, and 9% of baby boomers. I don't really know what that breaks down to be in terms of age demographics. You can look that up for yourself. Okay, personal loans was the most popular choice. 46% of those borrowed $5,000 or more. And then the second study from Magnified Money has to do with what the sentiment is and the, emotions behind people actually taking out trades and trading in general, right? Because what we're seeing, so now, okay, we've got first piece, which is that, this doesn't represent everyone in America, but we've got a piece of data telling us that a lot of people are taking out loans. We've got data that we've shared with you recently where personal savings is down. Consumer standards are at an all-time low. So of course, we are going to see an all-time high amount of credit be taken out. We just won't probably get that data for a couple more months. So now, what's the sentiment? What are these guys operating off of trade plans? How is retail really handling this? Well, it turns out badly. According to this other study, 32% of investors say they have made a trade while drunk. Let me say this again. 32% of US investors that they surveyed said they have made trades while drunk. Gen Z members fell into the trap more than any generation, with 59% confessing to drunk trading. Only 9% of baby boomers admitted to the same thing. 66% of Americans admit to making impulsive investing decisions. There's two newsletters that I write. I write the Empire Alerts, which is paid, and I write the Bull Run Forever, which is crypto-based newsletter. It will be paid, okay? So get in there, enjoy it while you can. We will move that to paid soon. It's just how it goes, right? I've written over 28 emails with a huge amount of free nuggets in there, habits, processes for how to fish. Not here's what to fish, but how to fish. Yes, big shocker, 66% of people are not operating off of a trade plan, and they're reading a tweet or they're letting their bias flip-flop them into short, long, and make really, really bad decisions. Most investors, 58%, agree their portfolio performs better when emotions are left out of the equation. 58% agree their portfolio performs better when emotions are left out of the equation. Interesting stuff, right? And this is all stuff that I guess common sense would tell you, yeah, it's probably true. Like, this is probably, what's happening. This is probably what people are feeling in terms of if you keep emotions out of it, you'll probably do better, right? 37% of investors have lost sleep worrying about the stock market, a position, and 30% have cried over investing. They have cried over their positions. So this on top of lockdowns, on top of, even if you don't understand a lot about money, you see them just printing trillions and trillions and trillions. You have no plan. You have no, backup. It's gotta be pretty stressful for the average person. It's leading them into making some really, really bad decisions. Furthermore, there's some data, which I won't go too deep into this, but from the Addiction Center. It's called the Addiction Center. Basically what they're doing is they did a deep expose on Robinhood and similar apps, and they're comparing that to an addiction. So they're basically comparing this to gambling addiction and drug addiction, which makes total sense. The gamification aspect of some of these applications is just dangerous for young people and for people who are feeling desperate right now, people who are on the hunt for yield because they're feeling hyperinflation in their lives. They're definitely going to be manipulated in this current landscape, right? And I've talked about that piece before. All right, so now let's pivot now into the BOA and Goldman data. Just really quickly touch on this is the S&P 500 right now has gone 196 trading days without a 5% pullback. Some other times when that happened is February of 2018, July of 1996. We've got August of 2015 was another time, March of 1994, right? So not a whole lot of other times. And these are usually around times of, you guessed it, collapse, disaster, resets, okay? Next is the number of new S&P 500 all-time highs in 2021 is on track to be the second largest in a calendar year since 1928. Since 1928, the most amount of all-time highs in one calendar year. Getting pretty interesting, right? Goldman's derivative strategist Rocky Fishman observes that 7.8% the SPX 1 month realized volatility is just 10th percentile compared with the last 50 years. Next thing, check it out on the screen. The SPX hasn't fallen over a 2-month period since October, the 4th longest such streak ever. The SPX hasn't fallen over a 2-month period since October, the 4th longest such streak ever to occur. The last time we had it was before the dot-com bubble. We saw a big increase, and then we've got in the late 1950s. Okay, and the last piece I want to share with you is the 1-year VIX index has risen to 26. And it's interesting because since 1940, the only times the S&P 500 has had realized volatility well above 26 for a full year, which is what I just said, has been around the 1987 crash, the great financial crisis of 08, 09, whatever you want to call it, and of course the Corona crisis. So these things start to really look interesting, don't they? When you stack, and we can kind of start to create a narrative that, okay, we are seeing that meme stocks are getting more and more popular. NFTs are getting more popular, which to me right now, with how that market is, I have a hard time distinguishing between an NFT and a meme stock. Meme stocks in the crypto space and meme stocks in the stock market space. So those are getting tons of attention. Those have tons of volatility. It's because people are doing what? They are hunting for yield. As Fishman points out, momentum chasing and depressed volatility are the two key drivers of today's fragile markets. As long as we're seeing that, then we know that that's what's happening. And the expectation here in the market is that we are going to see more volatility in the market itself, not just in meme stocks and NFTs and all these really, really risk assets, right? Because that's the extreme end of risk assets. And so people are taking riskier chances on riskier assets to get higher yield for some sort of reason. It's because they know they don't really have a choice. There is no savings account that's going to give you a good yield. There is nothing they can really do with their money to give them a good yield. They've ridden this extended unemployment benefits for as long as they could, and now they are looking to obviously, multiply their gains as quick as possible. This is the foundation for a future disaster. I'm telling you now, this is going to be a disaster. Just when? Who knows? Okay. So anyways, that's what I got for you. If you like this, click the like button. Help us get up and do the algorithm dance, as well as if you're brand new here, subscribe, hit the bell notification, comment below if you got something to say. See you soon.